by Joe Elmlinger, Head of Client Solutions, and Alex DeFeo, Senior Portfolio Manager at Lake Hill. We wrote about weekly options nearly a decade ago after the exchanges listed them and volumes subsequently skyrocketed. The Popularity and Pitfalls of Weekly Options 2014. We are seeing nearly the same phenomenon with 0 DTE options, 0 days to expiration, along with similar eye-catching headlines. We conducted an identical analysis for 0 DTEs and our conclusions may surprise some investors. There are a ton of pundits promoting 0 DTE option trading strategies. Many recommend selling or shorting 0 DTE to collect the fast-decaying option premiums, theta. Others advise on buying them for the potential lottery-like payouts. Currently, backtests that only go back a year or so are used to justify shorting 0 DTE outright are in a spread format. Some strategies also involve midday entry, exit, and legging signals. In addition, just as with the weeklies, the 0 DTE options have the benefit of self-hedging. They automatically expire, which provides a stop loss of sorts. This was and is also a reason for trading the weeklies. Simply selling, or buying, a weekly would naturally delta hedge in 5 business days. This makes it easy to trade without the added complexity of rolling positions or hedging with futures. The 0 DTE is the same except on a much shorter timescale, 6.5 hours or less. The problem with relentlessly selling or buying options is that it depends if those options are expensive or cheap based on simple odds over time, i.e., what is the expected value? As all options traders know, options are all about odds, and odds can only be calculated properly after repeated bets. Without any complicated options mathematics, what are the odds of a 0 DTE payoff? To answer this, we did a very simple study. We looked at the historical daily open-to-close returns and plotted a histogram. While the future may not match the past, and things are obviously different today, it behooves anyone who makes an investment decision, especially if they trade options, to at least look at what the historical base odds are. At a minimum, it provides insight into what something might be worth. Adding various filters to the data such as use all days versus use only days when VIX is greater, less than a threshold, or intraday high-low data, or 5-minute bar data, can refine the analysis. We found that the results are all basically the same irrespective of how one manipulated the data. Our conclusion: 0 DTEs on average are fairly priced. There is no material advantage to systematically shorting or buying them. Currently, they appear to be slightly cheap, but profiting from that cheapness takes many bets taken over a long period of time, probably more time than most traders can stomach. We first analyze a histogram of S&P 500 returns from open to close 0930 ET to 1600 ET using data from 1996 to 2023. The fair value of an at-the-money ATM straddle is simply the sum of the frequency of returns times the return bin. An example: if the 0 DTE ATM straddle is trading for $20 with the S&P 500 index at 4,050 bits per second of the index, is it wise to sell that straddle? According to the histogram below, we can make money so long as the 50 bits per second we collect covers the expected daily market moves. If the market stays within the 2 largest bins, 24% plus 28% equals 52%. We are winners. So currently 52% of the time we will be profitable. That sounds nice. The problem with winning 52% of the time is that you might be winning pennies 52% of the time but losing $48% of the time. On further analysis we see that when we win, the market moves on average 0.23%. When we lose, the market moves an average of 1.20% against us and sometimes much more. When we win, we earn an average profit of $10.80. 50 bits per second minus 0.23 bits per second asterisk 4000. But when we lose, it's a whopping average loss of $28. 50 bits per second minus 120 bits per second asterisk 4000. This rudimentary analysis shows that given today's prices, 50 bits per second for the ATM straddle, buying the straddle is the more advantageous trade. The problem: selling this straddle, even for negative edge, will show profits more often until the losses eventually show up, so most folks opt to sell in search of short-term profits. Zero DTE as a new trading tool is likely here to stay. There's lots of commentary on their risks, benefits, impact on the markets. We think they add value to the toolkit for traders and investors. They do not seem particularly mispriced. If you have a strategy for buying them or selling them, each can work. The key is to have a basic handle on the odds. Currently, the simple analysis shows they are not seriously mispriced, just slightly cheap if one has staying power. Frequently asked questions about zero DTE. Options Lake Hill is actively monitoring the zero DTE options and their overall impact on markets and the options ecosystem. Volumes in zero DTE have exploded and now account for a significant amount of overall trading volume in the equity index options markets. Zero DTE are options that expire on the same day, at the end of the trading day. That is, they have 0 days left to expiration and therefore are extremely short-term investment products. The primary volume in zero DTE is in S&P 500 index options, not single stocks. Given that these index option products have traditionally been used by institutional traders, we believe that most end users are professional traders and sophisticated market makers. There has also been some uptick in retail traders, but we suspect that they are among the more sophisticated retail traders and that they are not the driving force in zero DTE options. To gain insight into the type of end user, one would have to know which firms are clearing the trades, which is non-public information that only the exchanges have access to. The advantage of zero DTE is that one can take an extremely short-term, daily, view of the market. While the zero DTE has only recently proliferated, one can look if historically selling them, for premium collection, or buying them, for hedging, protection, is the better trade. Our analysis indicates that both strategies can be profitable. For example, a simple strategy of selling zero DTE option premia, either outright or via various option spread trades, has recently been profitable. However, our research indicates that over longer periods of time, multiple years, it may be more advantageous to be a net buyer of zero DTE options. The advantage is the daily instant feedback on market events with no overnight risk and daily recalibration to the market level. A disadvantage is the zero DTE is unlikely to respond to longer-term movements in VIX or offer protection to overnight moves. They are unlikely to provide significant protection or significant income for an institutional-sized portfolio. Hence it's more of a trader's product. The average trade size is around 2 contracts. However, the ultimate positioning by a trader is very likely much higher. Average trade size across the industry has been declining due to the advent of algorithmic execution in the options market. Brokers have offered execution algorithms in stock trading for many years but have developed algorithms for options trading in the past few years. A simple example of an execution algorithm would be one in which the executing broker can break a 100-lot order into small, odd lots, to minimize market impact and effectively deal with high-frequency traders. Most zero DTE positions are not held to the end of day expiration but rather are closed out at some point during the trading day. There are many strategies that can benefit from zero DTE both for hedging or income. See answer number 3 above. However, given the balance of risks and potential benefits, we think zero DTE is best suited for shorter-term and smaller traders. We do not currently see it as viable for larger institution investors who use or want to use index options. Note that even if one invests in longer-dated index options, say, 30 days out or more, one should have advanced systems in place to monitor the zero DTE because they can impact other options. We also suspect that quantitative traders could be using zero DTE in place of index futures. An intraday momentum strategy, for example, could be executed using 0 DTE options and a built-in stop-loss. Our analysis is that 0 DTE may suppress volatility over short periods of time but could actually increase volatility over longer periods of time. The logic is that anything that squeezes the market, VIX, realized volatility, or anything else, ultimately resurfaces at other times, i.e., the overall volatility level ultimately evens out. With 0 DTE options, we believe that there is potentially a risk that if the trading activity is suppressing volatility, due to the counterparties, market makers hedging the 0 DTE trades in the underlying index, then ultimately positioning could build up over time and can cause an explosion of volatility, potentially at the worst possible time. There may be unintended systemic risks to the markets arising from 0 DTE options. This is not necessarily due to 0 DTE options themselves but may arise if some clearing firms lack the systems to charge margin or manage risk for intraday positioning. Some brokers, clearing firms primarily, and perhaps only, look at positions at the end of day. Therefore, traders may be able to trade 0 DTE without posting any margin or collateral. This puts the broker, clearing firm at risk if their client loses money and has not posted margin in their account. Many smaller brokers, clearing firms may potentially be at risk, which further puts the overall clearing mechanism at risk. This is our top concern currently with the proliferation of 0 DTE option products. Joe Elmlinger is head of client solutions at Lake Hill. For over 30 years, Joe has been a pioneer in derivative sales and is recognized as a leader in equity derivatives, structured products, and customized financial engineering for clients. Previously, Mr. Elmlinger was head of sales for equities and derivatives at Société Générale. Mr. Elmlinger spent the majority of his career at Citigroup and its predecessor, Salomon Brothers, as global head of equity derivatives. He has also held senior roles at Bankers Trust Company, Merrill Lynch, the board of directors of ISDA and the Options Clearing Corporation. He has a BA from the University of Vermont and an MBA from Stanford University. Alex DeFeo is a senior portfolio manager at Lake Hill with a finance career spanning more than 2 decades. Prior to joining Lake Hill, he was a senior portfolio manager at Goldman Sachs where he focused on alternative risk premia and volatility strategies. He has also held senior positions at Credit Suisse, where he served as the head trader and portfolio manager for the Alternative Beta Strategies Group, and at Bank of America. Alex has been a guest lecturer at the London School of Economics and an instructor at UC Berkeley. Some of his research has been funded by the U.S. Army, Department of Defense, and the National Science Foundation. Alex earned an MS in Mechanical Engineering from the University of California, Berkeley, and a BS in Mechanical Engineering from the Massachusetts Institute of Technology.